present. My name is Kim, this is Holly, and this is Jay. We're going to present our virtual trading project. So first, I'm just going to introduce a little bit. We all know we have two approaches to investing in the stock market, the passive and then the active. So in fact, in 2020, a study shows that 79% of fund managers, they fail to match the performance of the S&P 500 index in the long run. So meaning it's hard to beat a benchmark. But if you're willing to pay higher fee, do more work in order to potentially generate higher returns, then an active portfolio may be a better choice for you. So usually we have four common methods of view, but we're just gonna focus on swing trading for our group, which means holding positions for several days to 2 weeks. So swing trading is when we identify and taking advantage of short-term price swings in the market, and Holly gonna go details about that.
Yeah, due to the increased risk of volatility in active trading, we first set some risk management practices to help us preserve some of those gains and minimize losses. We decided that no more than 1% of our account could be risked per position. We used inverse ETFs instead of shorting when possible. We also held more cash than our policy portfolio to take advantage of buying opportunities and buffer against volatility. We purchased ETFs versus individual stocks. And we also took advantage of some market timing. We decided we would exit all equity and bond positions before FOMC to avoid volatility. We started with the big picture. Every week we'd have meetings about market sentiment, GDP, inflation data, news, headlines, and this is where we would decide for the week how much we wanted to allocate to each category of asset classes. As you can see here, this is what it looked like week to week. We would decide some weeks to do more in US equities, sometimes more bonds, sometimes more cash. After our weekly meeting, we would go down our watch list on TradingView. This is where we had over 20 sector ETFs and index ETFs, and we would look at the technical charts on the one-day view to see the setup of every sector. For our technical analysis, this is kind of what we would look for. We would look for a beat down here of a ETF or security. We would look to see if the price was above or below this 180 simple moving average. You can also use the 200-day. We like the 180. We would look for a breakout here of a full candle close above the 9 SMA, simple moving average. If we saw the candle, we would come down to the RSI and look for positive momentum here. This would be a confirmation. Another confirmation would be a crossover here on the MACD. If that looked good, we would kind of zoom out maybe to the 1 week or the 1 month view and see what the chart patterns were telling us. There's bullish and bearish chart patterns. And then before actually entering the trade, there were more indicators that would help us time the entrance and exit to further maximize our gains. And Jay's gonna talk to you about those.
All right, for the favorite part, right? A lot of you have asked me what I use. So I use TradingView. I have the paid subscription. If you use the free one, you can only use 3, but my paid one, I can use 10. But what indicators do I use? I've already done the research and I've tried these out and have had some very solid gains. VWAP, volume weighted average price. I use an MDX indicator which spots bullish and bearish rallies. So that helps a lot. I also use a QQE mod, a qualitative quantitative estimation, and these quants can crush the markets if you use it wisely. I use supply and demand indicators, but also I mark levels as well. And trend lines with breaks, which I'll go over in a minute, how you use that. And of course, the buy and sell alerts. Oh. My favorite show, Billions, good inspiration. One of my strategies is I take the emotions out. I always mark my levels. I have a plan and I have an edge. So never trade with emotions ever. I use the fib lines or Fibonacci retracements, and it's pretty easy to use because a lot of apps you can press the top and hold it down and you could get these levels automatically, which is resistance, support, a trend, a signal, and a ratio. Price and volume, very important. Supply and demand, VWAP, VIX, the volatility index, which I'll go over in a second, why I use that. And level 2 order flow. Some are free, some are not. And historical patterns, which I'll go over why I use that and how that helped me on FOMC. Technical analysis, like Holly explained. And always have a stop loss, no matter what. So on one of my screens, this is what I have. This is the Webull desktop. This is the VIX and this is the SPY. I keep them together so that I can see this. Notice how SPY is going down and VIX is going up. But over here I have a fib line to mark the levels. And look at VWAP, the yellow line right here. Watch what happens when it switches over. It does the opposite. And that is called confluence trading. And my intro to level 2 is this. Over here, you can have this on. You can see what buyers are buying, which contracts, which positions, how many shares, all of that, even positions and contracts, and what they're selling as well. And over here, you've heard me say this in class, that's a spoofer. So this, 4,100, all those shares, it may have moved the markets, it may have not. So there's also some buyers out there that may have saw this, gotten in, and it was nothing, and they lose.
Okay, so to sum up, here's our tables of performance between active and passive. So we're glad that active outperformed policy by 0.96%, and we also have positive alpha, higher Sharpe ratio, trader measure, and positive information ratio. So it's actually a very short-term period, only 24 days. Both portfolios will employ diversification strategies would result in overall risky investment with some mixtures of associated risk level. We have positive beta value indicating that our active generally moves in the same directions as the market. The Sharpe ratio is positive, indicates that the return is relatively good compared to the amount of risk that we have taken. The M-squared measure for the active is 0.14, indicate that the active beat the benchmark portfolio. And last but not least, the information ratio of 0.52, showing that we generate excess return more consistent than the policy portfolio. So here's our graph results. And can I get the clicker? So the graph shows that the passive portfolio is more volatile compared to the active portfolio. I just want to notice the down right here. That is because we have a lot of loss on bonds due to prime rate increase. So there were no specific outliers in our case, except for one particular trading day in the first week of May. And then for the SCL graph right here is the excess returns of the portfolios. So it's kind of somewhat flat because it's suggesting a moderate level of beta. So for this, we do return by asset class. We compare between active and passive. So best performing for active will be international and bonds. Worst performing for active will be natural resource and cosmetics. And for passive portfolio, best is cosmetic international and worst is natural resource and bond. So as you can see right here, there's a lot of opposite between the active and passive. This is due to market timing, asset allocations, and technical analysis. One thing is, you guys can see all of the asset class are generally comparable for both portfolios except for real estate. Real estate, we didn't do any real estate considering the current stress market and present worldwide circumstances, like how the prime rate increased so much. So real estate is not a good thing to invest right now.
Return by security, our best performing securities were Yang, which is international equities. This is a triple leverage, China large cap. We also did well on triple Q, which is the NASDAQ index. Our worst performing securities were the inverse ETFs of the NASDAQ and SPY due to not being able to sell our positions on the app. So we held them longer than we would have liked.
And here we have FOMC, the Federal Open Market Committee. This is a picture of Jerome Powell. Know his name if you want to get into the trading markets. Mark him on your calendar when he speaks, because market timing. Whenever he speaks, the markets will move. And it's a potential day for solid gains if you mark your levels right, if you know what you're doing. But there is a lot of market volatility, a lot of market participation, enthusiasm, all of that. But, because of the words that come out of his mouth, like about supply chains, interest rates, inflation, possible recession talks, all of this is going to move faster than normal, because on this day, this is what I see. And I know it looks a little scary, right? But this is what I see every day on TradingView. This is the SPX and moves just like SPY. And these are my trend lines with breaks, the one I was telling you about. Watch how I used it. Triple Q moves just with SPY. this is where I entered. Like I told Holly, I said I'm gonna use historical patterns and data. 5 minutes before the market started, I got into long positions and this happened. As soon as it started at 11 a.m. our time. Remember, it is in the east, so mark 3 hours. Over here, number 2, that's when, we started talking about interest rates. And over here, as you can see on number 3, that's power hour. That is the final hour of the trading markets, and everything went down. And as you can see, even my indicators found it. Notice how the red volume is going down, even the MDX indicator, which is this red arrow pointing down, and the trend line would break is red, and it passes down that candlestick. That's when you know it's gonna tank. And because of all this that I did, we had a good solid gain just from this, a 359 profit. And I'm gonna turn it over to.
So our active portfolio ended up generating a higher return than our passive due to the following things. Market timing, we successfully avoided some volatility and captured gains where our policy did not. However, we also missed out on gains in domestic equities by trying to time the market. Asset allocations, our weekly meetings helped us stay disciplined, helped us avoid emotional trading decisions throughout the week. Our use of leverage helped us generate those greater returns, as you saw with the leveraged ETF. Our risk management, exiting positions at a loss, helped us avoid excessive losses and also preserve some of those gains. Our technical analysis is what helped us know when to enter and exit positions, and we did learn that we should not short when it's above the 200-day SMA.
And thanks to our strategy in focus, the last couple of weeks, our main fund is up.